Hi, so today's video is on a very specific topic, and that's how to attract crypto market makers to your exchange. Now I understand that for 99% of the people who might have clicked on this video or come across randomly, it won't be interesting, although maybe you can listen in if you're curious. But if you're an employee at a centralized exchange or a decentralized exchange and you are looking to attract liquidity providers on your platform, this really is going to be the video for you. So my name is Justin Danathan. I've been invested in crypto since 2015 and I've been working in the space since 2018, mostly with crypto market makers and more recently for crypto market making firms. And so the discussions of exchanges trying to attract us to onboard and allocate capital and trade on their platform is something that I've done hundreds of times, not on a daily basis, but at least on a weekly basis. And so I thought I'd make a video to explain first maybe the value add of market makers for a new exchange or even just a long-lasting exchange, and the different criteria that market maker look at when evaluating an exchange, and then also the factors or the data points that they'll be looking at within a market making incentive program and how to design it. And then last, maybe some additional considerations that are worth mentioning when you are talking to market making firms to maybe engage them beyond all the factors that I would have discussed before. So without further ado, we will start, and I will go to this very slide, which is supposed to be a short recap of another video that I've done that's like a 20-minute long video on why market makers exist, how they operate, the risks, the different types, and so on. This is not what we're going to try to do here, but if you're working at an exchange and you don't yet know what market makers do and you don't understand what the whole fuss is about, hopefully this is going to be helpful. So market makers essentially support liquidity on your platform. And that's one of the most important things you can care for in order to give a good user experience. So on an exchange, the sole purpose is create the right environment for traders, retail users, hedge funds, whoever wants, family offices that would want to allocate. You want them to feel at ease and also to be happy about the pricing. And that's what market makers help with. So when we talk about liquidity, we talk about having narrow spreads, tight spreads, so a small distance between the best bid, the first willing buyer, and the best ask, the first willing seller. We want those spreads to be as tight as possible. Why? Because it means that it's easier for people to acquire assets close to the mid price, so close to what they think at that time might be the fair price. If the spread is very wide, so the first willing seller is much at a higher price, you as a buyer feel like you then have to buy at a higher price and you're not happy about it. And similarly, if you're selling and the buyer is much lower, you're not happy because it's far away. The other component, of course, is that with the spreads being wide, it's more expensive to trade. So think about it. If you're getting in and out of trades on an asset, quite regularly, you have to buy at the ask, and then when you want to get out, you have to sell at the bid, which is at a distance from the price you got into, right? And so the wider that distance is, the more money you're losing on each trade just by crossing the spread. And so the tighter the spreads are, the less money you're theoretically losing on your trade. Beyond the tight spreads, you also want to have good inventory, good order book depth, which means that there's capital, there's enough inventory on either side of the order book. And typically on the buy side, that's US dollar or euro, like fiat currencies or stablecoin. And on the sell side, that's the token that's being traded, the Bitcoin, the Ethereum, the Cardano, the Polkadot, whatever. If there's not enough inventory, it might be that large players that want to trade in size can't get their trade filled. Or even if they're not trading that big a size, if there's not a lot of inventory at each level in the order book, it means that the trade gets filled at a less advantageous price. So let's say there's, for example, 100 to be sold here and 100 to be sold here and 100 to be sold here, and you want to buy 500 worth, you're going to go through each level to fill your trade. You're going to plow through the order book, you're going to push the price up, and the average price of your trade is not going to be optimal. Again, there's a video that goes into this way more in depth, and that's not the point of this slide. And then in the case of a market maker, you also want to think about uptime, which are the quotes being streamed consistently over time? So is the market maker continuously quoting, or is he stepping out of the order book regularly? And so market makers, by being in the order book, typically tighten the spread because they want people to interact with their liquidity. They want retail users to take their limit order, the liquidity they're posting. They're helping with the inventory because they're, of course, depositing capital simultaneously on the buy side and the sell side. Just as a quick reminder, market makers are always or should always be quoting two-way pricing. So they should always be market neutral. They should always be ready to buy and to sell. And they should maintain a certain uptime. That's typically expressed as a percentage over a period. So it could be on a 24-hour period, or it might be on a monthly period, but they will say, we will quote in the order book 90% of the time. So that means that 90% of the time they are quoting two-way pricing, or maybe it's 95% of the time, which is better, or better still, 97% of the time. And so, of course, for your user, that results in a fairer, in a more efficient venue to trade on, or better pricing to interact with. On the flip side, if you do not offer this, users will typically go to more liquid exchanges. And there you've lost a customer, right? You've lost the lifetime value of that customer, all the trading fees they could have generated. Or maybe even they stay on the platform because, whatever reason, they're leaving some assets there or they're using some funky product, but they're trading less than they otherwise would. So if you're the most liquid exchange, everybody wants to trade on your platform. If you're the least liquid exchange, nobody does. It's kind of like that's extreme, and then depending on where you are on that spectrum, you get more or less of the volume. With that being said, let's move on to how market makers themselves, so I want to put you in the shoes of a market maker, how you think about exchanges that you would integrate. So kind of like new platforms that you would onboard, allocate capital to, and deploy strategies on. One of the big frustrations I think a lot of people get when they talk to market makers is they've created a platform on which it is possible to deploy capital and turn out a profit. And if you've got good strategies, you will make a profit. So they're like, look, why don't you try to generate a profit on our platform? That's not really how market makers think. Market makers are companies that need to make a profit like any other company. They're trading entities, but so by definition, they're also trying to optimize the returns that they get. They always want to get the best rate of return or the return on capital possible. And that pushes them to think about every opportunity in the context of what's the opportunity cost here. I'll give you a very simple example. If I'm a market maker and I have $1 million and I can get 10% or 15% or 20% returns on that 1 million by trading it on Binance, and I get approached by a new exchange and they're telling me, you could be profitable on our platform. And as a market maker, we start looking at the incentives and the setups and the volume, the spreads and so on, and we think we can probably get 10 or 15%. Well, if your return on capital is 15% and you can barely get 15% on that new platform, do you feel inclined to go through the whole hassle of integrating, onboarding, doing some due diligence and compliance check, betting on the future of that exchange that might be positive but might also be negative, deal with a whole new relationship, invest in the resources and the human capital and the time to get all that done? Probably not. And so that's what a lot of exchanges don't understand. If there's no ability for the market maker to exceed the rate of return they're getting on another platform, an existing venue that they're on, there's no point for them to integrate. And so they'll stay very cordial, right? They'll stay very nice and happy to have conversations. Also, even just keep an eye on your project to see how it develops. And if it gets better, then it might become more attractive. But at that point, there's no incentive for them to join. Now, there's something even more depressing, maybe, which is even if you offer a return on capital that is slightly higher, it might not be enough. Think about it. Again, I've talked about the resources, the time, the human capital, the tech integration, the maintenance and uptime that you have, to look at the algos and all the things that go on into integrating into a new platform, on top of all the operational hassle of transferring capital and so on and so on. Do you want to do it if the return on capital on that platform would be, let's say, 17 or 18%, and your benchmark, let's say, is still that 15%? Probably not, actually. For those 2-3 additional percent, it might not be incentive enough for them to move. And so everything ends up being placed on a spectrum, or more accurately, in a prioritization queue, where we essentially as market maker would rank new opportunities from the most attractive to the least attractive. And an analogy I used with a friend of mine that was starting an exchange, I don't know if it's politically incorrect, but I was saying like being a market maker is almost like being an attractive girl where you know you can go on dates with many different guys, I guess, but who are you going to go on a date with first? The most attractive guy or the least attractive guy? Probably you'll give a shot to the guy that you're the most interested with, the one you see the most potential with, right? And as a market maker, you look at exchanges in exactly the same way, right? Which is, okay, you look at this new platform and you could make 20%. Huh, okay, that's interesting. That's higher than the 15%, let's say, if that's the return on capital rate that you're using. And then you hear about a new exchange that has maybe a grant from the foundation in that ecosystem. It's like a perp DEX, let's say, and you could make 30% or 50% or even 100%. Are you moving that opportunity ahead of the queue or putting it at the back? Probably you're putting it ahead. And then maybe a new perp DEX, or hybrid DEX or something like that comes up, and you can make 150%, maybe 200% based on your valuation of the project and the airdrop farming that you could do by just trading and doing decent volume on that platform. Now you're putting that ahead of the queue. So of course, those things don't change on a day-to-day basis, right? There's a certain commitment and there's strategic relationships and stuff to be discussed and negotiations. But the thought process itself is all about that. So it's this opportunity cost. You have like a base rate, and if it falls under, it's not even being considered. If it's a bit higher, okay, maybe good. If it's much better, then it gets put ahead in the prioritization queue. And so as a market maker, you typically would have lists of maybe 10, 20, 50, hundreds of different projects you could do stuff with, but they're in the prioritization queue, right? So you're looking at them, but you're not actively integrating with them. Also keep in mind that within that prioritization queue, there's also existing platforms that need to be updated and maintained, and that still requires resources and capital and time. And so you're again being pitted against, maybe upgrading the connection with OKX or Binance versus integrating your new platform. And so depending on what they think is going to bring them the most money, you might still not get it. Now, after this very depressing slide, I still want to talk about the factors that market makers will check when evaluating a new platform, and hopefully that gives you hints as to what you can go towards to look more attractive versus less attractive. And I've kind of ranked them in order of importance, except maybe the last two, because I want to talk about them in the next slide. Let's start at the top. The very first one, so ironic, so frustrating, and it's about large volumes. So the chicken and egg situation that a lot of new exchange find themselves into is, okay, we want more volume, so we have more users, people talk about us, we can earn trading fees from all the people, speculating on our platform. But in order to do that, we need liquidity providers, we need market makers. How do we get a market maker? Let's have a call with them. What do they want? They want to have a platform where there's already a lot of volume. It's like, well, how can I get the volume if I don't get the liquidity to start with and for my clients to have like a good order book to interact with? You can't. Okay, so how do we get out of this? And the honest answer is, I think nobody's really figured it out. I mean, there's many different factors which we will cover, but ultimately it's kind of the relationships you have with the market makers, maybe some incentive program, maybe some strategic alignment, maybe some equity giveaway, maybe the strong backing, maybe a super active community, maybe being the core project within an ecosystem that's attractive. And maybe they will then integrate regardless of volumes, but the absolute best setup for a market maker is a platform where there's already a lot of activity, because that means a lot of people will interact with the liquidity that they post in the order book, and so they can make money with their market making strategy, which is essentially making very small profits off of the spread for each transaction. Along with those existing large volumes, they would ideally want the volume to be generated by dynamic and organic taker flow. Now, taker is typically a term used in opposition to a market maker. So when you're a market maker, you're using limit orders to post liquidity and wait for someone to be the aggressor, to be the taker of the market you're making, the taker of the liquidity you're posting. And as a market maker, the absolute best scenario, platform, lots of volume, no other market maker, so there's no making or like market making competition. You're the only market maker, and you get a lot of taker flow. You get a lot of organic retail funds, family offices, asset managers, and so on that are just taking bets on different assets, but they're using market orders. They're taking the liquidity that you're posting in the order book. That's how you make a lot of money. The moment you have more maker flow, you have more market makers alongside you as a market maker in the order book, it becomes less attractive because you have more competition, essentially, right? After those two, wait, let me take that off. The two other factors will be a variety, a breadth of products and a breadth of markets. So to have a lot of different things on your platform. And that's typically what you see on full-fledged exchanges, right? So the larger exchanges, the ones that are long-standing, they typically have a lot of products. By that I mean they have spot, but they also have perps and or dated futures and or options and or dual currency products and or yield products, interest rate swap products, staking products, launch put, launch pad, and so on. Like all those different things kind of attract different types of users, typically retail users, which means there's different strategies and different perspectives that are being deployed on your exchange. And also as a market maker, it means that you can have different strategies and different profiles in those different products and maybe hedge some positions in one product into another and so on. Same thing with the markets, right? That just means as a beginning exchange, you'll probably have Bitcoin and Ethereum, for example, as like your two first market. Is that attractive? Is that cool? Is that differentiated? Probably not. As you start adding more markets, it starts to become a bit more interesting because that means market makers can deploy their strategy across multiple assets, not just the usual Bitcoin and Ethereum, which are not going to be competitive in the first place because we could trade Bitcoin and Ethereum on Binance and OKX and Bybit and KuCoin and Coinbase and Kraken and all that stuff. The other stuff start to become maybe like the more technical things. One would be clear and easy to use API documentation. So of course, market makers are not based on human activity, as in you don't have like a human pointing and clicking to input orders. It's all algo and quant based, right? And so all the orders are going through from a computing power or like a computer and servers interacting with the exchange matching engine. And so in order to interact, they need to connect via API. And so the documentation, which is essentially the roadmap on how to integrate that specific exchange, if it is clear, if it is familiar, if it's based on the same coding language that the tech team at the market maker use, that makes it easier. And conversely, if it's really different and very clunky and messy, it makes it harder. To go back maybe to the analogy of like, let's say in the dating world, it's like if the person is living very far away, it's a big hassle to go to them, it puts a strain on maybe the chances of you guys, ending in a relationship or making it work. Whereas if you're very close to each other, it's just a lot easier, right? That's the same thing with the API documentation. It's like if it's familiar, if it's easy, if it's fast, the hurdle of integrating to the exchange is lower, and that's a good thing for the market maker. The other two things, again, are not going to be, deal breakers or deal makers, but they're about sharing or at least having a good setup for custody, for fiat on-ramp, off-ramp, the right kind of transfer setup, to move assets from one venue to the other and so on. If you have those, let's say you're using the same custody provider as the market maker, that helps. If you're using the same banking partner as the market maker, that helps. If on the other hand, all of those are different, we then have to maybe figure out, things are going to be a bit slower. It's going to take a bit, more time for the fiat transfer through the banking network and so on and so on. So we can't use you as an on-ramp, off-ramp partner and so on. So if you have the same setup and you go with like popular, legit, recognized providers, it just helps. It makes it a little bit more attractive. Now, the other two are a bit weird and not the usual thing necessarily to talk about. And it's not going to be attractive for all market makers, but this one we will talk in the next slide, so that's why I put it in bold and at the end, but it's having a strong market maker program. And you wouldn't believe the number of new exchanges and new venues that don't even have a market maker incentive programs and think that a market maker is just going to be blown away by their vision and how cool they are. And the truth is, even though we would be blown away by the vision and how cool you guys are, at the end of the day, we as BD, business development partnership people, as excited as we are, we still need to pitch that idea to the trading team. And the trading team is a lot more cynical. They're getting commissions off of the profit derived from their trading strategy. And they look at things in very clinical terms, right? Like how much, can we make? What is the flow? What are the spreads? Which markets? Does it work or does it not work? And the market maker incentive program is going to be the thing that's going to maybe sway them one way or the other if it's designed in the right way. And we'll look at this. The other one that I did want to mention is whether your exchange is focused on new token listing. And that's only going to be relevant for a few market makers, but it relates to those that offer token market making services. If they do, they'll be very interested in platforms that do list new token because there's a very organic, very natural alignment. You both want to talk and cater to the same people, new projects that would be launching on a platform. So there's a natural synergy between the listing team at the exchange and the business development team at the market maker, who both want to be talking to projects and both want to support the launch. And so if you're listing a lot of projects on a weekly basis, it's quite easy for you to go to the market maker and say, well, actually, we talk to a lot of token projects. We'd love to introduce them to you. But, for it to make sense, you should be integrated into our exchange so you can support them when they do launch on the exchange. And so as a market maker, you're like, I really want those token listings, so maybe I should integrate on that exchange so I can support them on that exchange, but also build a relationship with that token project so that I can support them on their future listing on other venues that I would already be integrated in. So there's that to think about. Moving on to the next slide, which is so important and I hope probably won't be too complex, but it's the market maker program. You need a strong incentive program. If you do not, it's going to be very hard for you to be competitive relative to all the other platforms that are looking to attract market makers and might be a lot more aggressive than you. So I'll go through the points. I can't design the market maker program because that would be a video on its own, but I'll go through the different points. Maybe the most attractive thing you can give to market makers is credit. If you give credit, you're essentially giving them free capital, right? Why is that so important? Because as a market maker, you're plugged in to a ton of different platforms, across a ton of different products, across a ton of different assets or markets, right? And so your capital is always spread relatively thin. So a market maker is never really sitting on idle capital. It's always putting that capital to use to maximize every cent it can out of every dollar it owns. When you give it credit, you make it a lot easier for them to deploy on our platform. Why? Because you require less capital. So if you're a new platform and you say, we need you to post 1 million in the order books and we don't give credit, you're essentially telling the market maker, you need to take 1 million out of an existing profitable setup and move it to this new platform that we're super excited about, but that you have no certainty will generate the same returns, will have the same activity, will have the same taker flow, and so on and so on. That's hard. If you do give them credit, you make that decision less difficult because you're telling them, use our capital. If it works out, you'll be happy, we'll be happy. If it doesn't, you actually haven't used too much of your capital. The other thing that's going to be super important and almost should go without saying is if you're creating market maker program, you have to provide attractive fee schedules to those market makers. Because they're posting so many limit orders on either side of the order book and providing so much of the liquidity, a lot of your user base is going to interact with those market makers. That means the market makers are going to be responsible for a ton of trades. Now, if you're charging large fees on every trade, it is very expensive for the market maker to operate on your exchange. If the fees are very low, or even better, non-existent, if you're giving them like a 0-0 maker-taker fee, it becomes inexpensive or essentially like a no cost on the trading fee, and that's a lot easier. Now, if you give both of those things, the credits and 0-0 maker-taker fee to a market maker, it almost becomes like a no-brainer for them to trade because it costs them nothing to kind of check out and see how much money they can churn out and then maybe put more capital later on, right? In some cases, by the way, I don't know if everybody watching this video knows this, but with market makers, sometimes they get negative trading fee. What that means is that for every trade they do, instead of paying the exchange pays them. And that incentivizes the market maker to be a bit more aggressive, to tighten the spread a bit more, so that they get more interactions, more trades, and essentially get paid on the trades they do, regardless of whether they make that much money off of the actual trade itself, because the exchange is going to give them half a basis point or 0.5 basis point or whatever it is. Margining is another component, maybe not necessarily included in the market maker incentive program, but if you have margining capabilities, you can essentially tell the market maker, just like you would in the credit, by the way, they would normally post some kind of collateral, but you're also telling them across different assets and different products, you are able to just deposit, let's say, 100,000 US dollar worth of capital and maybe do a 3-to-1 or 5-to-1 margining, which means that you can actually trade for 500k worth or 300k worth, depending on which ratio you use, with the margin capability. The other very important factor is the monthly retainer. If you offer a monthly retainer, you're essentially covering a lot of the costs that the market maker naturally incurs by running operations, right? So running operations like strategy as a market maker has a cost in terms of servers, in terms of electricity, in terms of manpower, in terms of time, in terms of attention, and so on, and just capital, right? If you give monthly retainer, if you give like a flat fee every month to provide market making services, it kind of swings the balance towards them wanting to do it versus not, right? You say, hey, we're paying you 10k per month or 20k per month to provide market making services. Now the trading team, the guys that were a bit cynical and clinical, before, they look at it and they're like, okay, I think I can make that much money on the exchange. Let's say I can't even make money, I can just break even, but they're paying me 20k to do this. So every month I have an assured 20k if I meet those requirements. Okay, maybe worth it. Now, of course, it might not be like the best or long-term solution because it costs you, the exchange, money every month with every market maker that you would give that to, but it's a solution. Another one that would be like a one-time thing would be an integration fee. So again, the integration, I won't go over it, but there is a cost associated with connecting to a new exchange on a tech basis. If you tell them, look, why don't we pay you a 10k fee or a 15k one-time fee so that at least we know it's going to cost you time and people and energy, to connect, but we'll give you that. So at least the connection part, that's covered by us. And then whatever you do on the exchange, that's, your own thing to handle. Could help. So I don't know if you see, but everything I'm talking about, it's almost like you're on a scale, right? Where it's like, are we going against it? Like we don't want to do it, or are we for it? Do we actually want to do it? And you have to kind of put your weight on different sides. And you don't have to use all of the things I'm listing, but some of the things I'm listing to kind of move them in the right direction. The other one is maybe more relevant for a lot of the DEXs, perp DEXs, hybrid DEXs, that would operate within a certain ecosystem. They will typically have like an exchange token or even maybe like an ecosystem token, like you're a DEX on, let's say, Aptos, and Aptos is giving you a grant in native token, in APT token, which you can distribute to maybe incentivize your retail users or your KOLs, or people building stuff on that platform, or market makers that would be providing liquidity. And so depending on how aggressive it is, it can be very attractive for the market makers, especially if they're bullish on the ecosystem, especially if maybe they can be the market maker to support that token launch on other exchanges. And so that might be very attractive to them, depending on how much you're actually paying out. This one is a bit of a given, but it should be an easy one. But ensure that you tell them, hey, we have like a dedicated team, a dedicated institutional tech team that can answer any question you have at any given time, especially while you're integrating, when you're connecting to the exchange, but even after that, when we do maintenance or upgrades and you need to, upgrade your own systems to match with ours, there's always a team that can address, your questions or support if you have any issue, or maybe some kind of like operational support when you need to do transfer of funds and so on. The other one is colocation, which is the matching engine, the servers of the exchange might be located in a certain region. Maybe it's like AWS in Singapore, or maybe it's a server farm in Japan, or maybe it's something in the US. And as a market maker, because you care so much about latency, about the speed at which your orders are being recognized and filled or accepted or canceled, if you want to cancel them, by the exchange, being co-located, meaning having your servers alongside the servers of the exchange, mean that all of that happens faster, and that's positive because it makes the market maker more competitive. That's about it on the market maker program. Again, I can't design the whole program like that, but those are the factors you need to kind of start putting on the scale of what you can give and what you're not willing to give to try to attract them. Now, I wanted to talk about other considerations that might be worthwhile mentioning, or looking at your exchange to see if you can offer that as a positive thing. First is the jurisdiction that you're operating on, and whether it maybe matches with the jurisdiction of the market maker. So maybe it's like you're a US based exchange and you're talking to US based market maker. Maybe that makes a lot of sense. Or maybe you're totally not on that front and you're based in the Seychelles or the BVI, and it's very easy for people to onboard, and you kind of want to let them know about it and know that they're aware of it. On the flip side, you also want to tell them if you're in a tricky jurisdiction, because maybe there's no point, they're never going to do it. Let's say you're in India, and India is a very tricky jurisdiction to deploy capital on and trade on and pay taxes on and so on. You need to say that right away, because that way you're saving yourself a useless conversation potentially. Strong backing. I'm talking here about maybe the VCs and the personalities that are behind your exchange. So again, let's say you're either a centralized exchange that is backed by some VCs, or a decentralized exchange also backed by some VC within a certain ecosystem. The fact that it would be an attractive ecosystem or very powerful backers is going to make you look a bit more attractive. It's like, oh, those guys are connected to this and this firm. We want to get in touch with those guys. We want them to be aware that we're supporting. We want them to think about us when they're referring market makers to projects or other people and so on. So just by association, if you've got that cool backing, you're going to look more attractive. And if you don't, presumably a bit less attractive, relatively speaking. The other thing, of course, is it almost kind of goes without saying, but the proper security components, which you should have in place. But if you do have a very good security structure, you want those guys to kind of explain why it is superior to other exchanges, why they should feel safer, while you're more unlikely to get hacked, and so on and so on. The other one, which I kind of alluded to, is partnership opportunities, and that refers to maybe like the fact that you're listing new tokens, but there's a lot of other things. Maybe you're very active on the marketing side, and you would offer the market maker to collaborate on some of the events you're doing, or some of the marketing things you're doing, or some of the campaigns that you'd be doing online, or participate in some Twitter spaces and so on, to kind of increase the visibility. All of those things, again, all the things in this list is like, it's not deal breaker, but it's something that, hey, we can talk about it, we can engage you on that front. So it's not just a clinical perspective on the numbers, which is what the trading team probably would look like, but maybe they can be pressured into accepting, because there are a lot of other alignments that are perceived by the business development people or the executives and so on. The other one, I would say, also goes without saying, but it's ongoing communication, both when you're pitching the market maker and after the market maker has integrated in your platform, is to make sure that you're always front of mind, that you've created the right relationship, that you can ask the market maker to step in when maybe some other market makers are out of the order book, or there's a new market that might not be super attractive, but because you have a good relationship, they will do it as a gesture of goodwill, right? Or maybe you're an exchange based somewhere and you've created like an other exchange in another jurisdiction, so it's like a separate platform, but it's the same company, and we're like, look, based on our history, we're doing this, would you be interested in, we can help you with getting more credit on this one, so you can support this one, which is maybe not going to be that exciting at the beginning, and so on and so on. So you want to think about all those different relationship angles that you would want. The 24/7 dedicated support refers a bit to the tech support, that I was mentioning in the market maker program, although that was just about tech. But I would say having quality institutional business development people that can talk to market makers and ensure that whenever they have a question, it's answered. Whenever there's a problem, it's resolved in a timely fashion. Whenever there's a change, they're made aware of it ahead of time and so on. All of those things are going to make you look very professional, and you're going to become like the preferred platform of the market maker, and maybe they'll be more willing to deposit more capital or engage in more markets or explore new strategic opportunities with you and so on. You do need to have ongoing communication. If you don't, it just makes you look like you don't care about the market makers, and they start taking their capital out. A fair environment, again, which I would say kind of goes without saying, but you want to make sure that you highlight the fact that you do not give advantages to other market maker, meaning the market maker program that you've designed is the same across the board. There's no other incentive. If you give other incentive, better incentive to another market maker, you're, without maybe knowing it, you're making them more competitive. And so it means that they can then start grabbing a bigger share of the volume and be more aggressive in the order book, and even maybe damage the profitability of the other market makers, the ones that are not benefiting from preferential terms. So you want it to be fair, and you want to highlight that it's fair. Nobody has any informational advantage. Nobody has a different market maker program. Nobody has, information ahead of time and stuff like that. Another thing is, even beyond the market maker program, you might want to give the market makers a ramp up period, which is to say, you've just integrated, we're still kind of untested, it's just a new partnership. Why don't we give you the absolute best terms to begin with? And then afterwards, based on your volume or the markets you're active on, we'll tailor a bit the market maker so that the incentives are aligned with your added value as a market maker. So that's where you're kind of asking, hey man, you need to do something for me in order to get something from me. But you would want to give them a ramp up period. You want to give them a few weeks, even maybe a few months to kind of onboard, connect, test some strategies with small amounts of capital, then increase the capital, and so on and so on. And if you make it very expensive for them, it just becomes a hassle. And if you make it very cheap for them, it just makes it a bit easier. I think that's everything I have prepared for you today, and we're 35 minutes in, so I think that's a good amount of time for a video. If you have any questions, feel free to comment down below. I look at them, I answer them, so you will actually get some kind of insights from me. And if you thought that the content was helpful, please put a like, please subscribe. It helps a ton. Thank you very much. Bye-bye.